Something is quietly unfolding across this country right now that almost no senior citizen is aware of. Each and every year, millions of retired Americans over the age of 65 are writing checks for tax bills they may not be legally required to pay. Not just one category of tax, not just two. 7 separate types of taxes, fees, and charges that arrive automatically, get added to recurring payments, and steadily drain retirement savings month after month and year after year. And the most frustrating part of all is that nobody, not the IRS, not your state government, not your county office, is ever going to pick up the phone and let you know that you may already qualify for an exemption. I want you to pause for just a moment and genuinely consider this. After spending 40 or 50 years in the workforce, after contributing to the system throughout your entire adult life, after finally arriving at the stage where retirement was supposed to bring some financial breathing room, you are still receiving bills that you may have been legally free from for years. Money has been leaving your account, sometimes thousands of dollars at a stretch, and nobody ever mentioned that it did not have to. By the time this video ends, you will know precisely what those 7 tax bills are, who qualifies to be exempt from them, and how to determine whether you are one of those people. So before we move any further, if you, your spouse, or a parent is over 65 and still receiving any kind of tax bill, please stay with me all the way through. This information could quietly save your family thousands of dollars this year and every single year that follows for the rest of your life. You are watching Retirement Watch, where we translate Social Security, Medicare, taxes, and retirement regulations into plain everyday English so you can make well-informed decisions with real confidence. I am Robert Hale. If videos like this one help you feel more prepared and better protected, please subscribe to this channel right now and activate the bell notification. The reason this matters so deeply is actually quite simple. Tax laws in America are written with hundreds of exemptions, deductions, and credits that were specifically designed with seniors in mind. But the system itself is not built to help you locate them. The bill simply shows up, you pay it, and the pattern continues until someone finally takes the time to sit down and walk you through it. That is precisely what this channel exists to do. We take the tax laws, the exemptions, the regulations, and we break them down clearly and calmly in language anyone can follow. So the seniors who deserve to hold on to their own money actually get to hold on to it. The retirees who are aware of these programs save thousands of dollars annually. The ones who remain unaware simply keep on paying. So please tap that subscribe button, enable the notification bell, and let us go through the 7 tax bills you may be legally exempt from in 2026 one at a time. Tax bill number 1, property taxes. This is the single largest and most widespread tax bill that seniors continue paying when they may not be required to. Nearly every state across the United States provides some form of property tax relief for homeowners over the age of 65. Senior homestead exemptions, property tax freeze programs, circuit breaker initiatives, combined veterans and senior exemptions, senior deferral arrangements. The terminology shifts from one state to the next, but the fundamental concept remains consistent. If you have reached a certain age, and in some cases if you fall within specific income thresholds, your property tax obligation can be reduced, locked at a prior year's level, or in certain states, removed entirely. The financial savings can be substantial. Depending on your state, your county, and the assessed value of your home, the appropriate exemption can spare you anywhere from several hundred to several $1,000s each year. And those savings carry forward for the remainder of your life as long as you continue to meet the qualifications. The error most people make is assuming the county will automatically apply the exemption the moment they turn 65. That is not how it works. You are required to apply frequently within a defined window each year. And seniors who miss that window typically forfeit the entire year's worth of savings. If you have never specifically contacted your county tax assessor to ask about senior property tax relief, this could turn out to be one of the most consequential phone calls you make this week. Even a single brief conversation can unlock thousands of dollars in savings every year going forward. In just a moment, I will introduce the second tax bill, which catches nearly every American senior off guard because it is buried inside their annual federal tax return. Please stay with me. Tax bill number 2, the additional federal standard deduction available to seniors. This one is sitting in plain view on every federal tax return filed by a senior citizen in America. Most retirees have no idea that once you reach age 65, the IRS grants you a supplemental standard deduction layered on top of the regular standard deduction. For 2026, that additional deduction can amount to approximately $2,000 for single filers and an even greater sum for married couples where both spouses have reached 65. This supplemental deduction shrinks the portion of your income that is subject to federal income tax. Across a typical retirement timeline, this can translate into thousands of dollars in federal taxes you would have otherwise handed over. And here is the detail that genuinely surprises many seniors. If you have been using the standard deduction ever since turning 65, but have not been specifically claiming the additional senior amount, you may have been shortchanging yourself for years. The common error involves using the prior year's tax software, the prior year's accountant notes, or last year's completed return as a starting point without adjusting for the additional senior deduction when you cross that age threshold. The IRS does not telephone you on your birthday to walk you through this. They simply process whatever return you submit to them. If you are uncertain whether you have been claiming the additional senior standard deduction, bring this year's return to a qualified tax professional and ask them specifically to examine the past 3 years. In certain situations, returns from previous years can be amended to recover taxes that were overpaid. Tax Bill number 3, State Income Tax applied to Social Security benefits. Most Americans are generally aware that Social Security can be partially subject to taxation at the federal level. What the majority of seniors fail to realize, however, is that the rules at the state level operate completely differently and in many circumstances are considerably more favorable. At present, the majority of states across the country do not impose any tax on Social Security benefits whatsoever. Some states never have. Others have gradually phased out their Social Security taxation in recent years. And among the states that do still apply taxes to Social Security income, many provide meaningful exemptions, or reductions, that apply specifically to older residents. If you reside in a state that does not tax Social Security, this particular point may not apply to your circumstances directly. But if you live in one of the remaining states that does still tax these benefits, or if you are simply not certain either way, this is a question worth answering before the week is out. Some retirees have been remitting state income tax on their Social Security payments for years, when they were actually eligible for a senior exemption or a partial deduction throughout that entire period. Others may find it worthwhile to adjust their tax planning approach in order to reduce that liability going forward. The mistake most commonly made is assuming that because state income tax was withheld from Social Security in the past, it must still be required. That assumption is not always accurate, and the rules do evolve over time. New legislation passes, fresh exemptions are created. What held true 3 years ago may no longer apply today. This is one of those areas where a single consultation with a qualified tax professional who specializes in your particular state can easily pay for itself many times over. Tax Bill number 4, Capital Gains Tax on the Sale of Your Home. This ranks among the most significant tax rules in the entire retirement landscape and simultaneously among the most widely misunderstood. Under existing federal tax law, when you sell your primary residence, you may be entitled to exclude up to $250,000 of capital gains from federal taxation if you file as a single individual, and up to $500,000 if you file jointly alongside your spouse. To be eligible, you generally must have owned the property and used it as your primary residence for at least 2 of the preceding 5 years. For many seniors who have owned their home for multiple decades and watched its value climb considerably, this exclusion can shield tens of thousands or even hundreds of thousands of dollars from federal taxation when the time comes to sell. And yet, every single year, retirees sell their homes without fully grasping this provision, without thoughtfully planning the timing of the sale, and without sitting down with a qualified tax professional beforehand. The resulting mistakes can carry a steep price tag. The error most frequently made is assuming that selling a home during retirement will automatically produce a large and unavoidable tax obligation. For most seniors who have lived in their primary residence for many years, the opposite outcome is frequently the reality. With appropriate advance planning, much or even all of the gain may qualify as completely tax-free. Before listing your home for sale during retirement, invest the time to understand precisely how this exclusion applies to your individual circumstances. A qualified tax professional or real estate attorney can help you sidestep costly missteps that might otherwise run into tens of thousands of dollars. A quick reminder before we continue. If this kind of straightforward plain English breakdown is proving useful to you, please subscribe to Retirement Watch and turn on the notification bell. We release new videos every week that dissect exactly these kinds of tax exemptions and regulations in language that respects both your time and your intelligence. The seniors who remain informed are the ones who save thousands every year. The ones who stay in the dark simply continue paying. So please hit that subscribe button now if you have not done so already. Tax Bill number 5, Vehicle Registration and DMV-related fees. This is among the most overlooked categories of tax bills in America, and one where meaningful savings are quietly available in nearly every state, year after year, for seniors who simply know to ask. Many states provide senior discounts on vehicle registration fees, license plate renewal charges, driver's license renewal fees, and various other costs associated with the Department of Motor Vehicles. The dollar amount saved on any individual transaction may appear modest, but accumulated across a typical retirement, they add up to hundreds or even thousands of dollars. In certain states, seniors who have reached a qualifying age can register a vehicle at a reduced rate or even at no annual cost for particular vehicle categories. Other states extend free or discounted state identification cards as an alternative to a standard driver's license, complimentary vehicle inspections, or longer renewal intervals that reduce the frequency with which you are required to pay. The mistake people most often make here is expecting the DMV clerk to automatically apply any available senior discount without being asked. That is not going to happen. The responsibility for requesting the discount, and in many cases for formally applying for it, rests entirely with you. Before your next vehicle registration renewal, before your next driver's license renewal, before your next trip to the DMV for any reason, spend 5 minutes calling your state's DMV office and asking directly, "Are there any senior discounts I might qualify for?" That single question has the potential to save you money on every future renewal cycle, often stretching across decades of retirement. And in just a moment, I will walk you through the 6th tax bill on our list, which is one that most seniors do not even recognise as a tax-related issue until it catches them off guard. Please stay with me. Tax Bill number 6, Medical Expense Deductions. This one is technically not a tax bill in the traditional sense of the term. It is actually a deduction that, when applied correctly, can reduce or entirely wipe out a portion of your federal income tax obligation, and it is one that almost no senior takes full advantage of. Under current federal tax law, qualifying medical expenditures that exceed 7.5% of your adjusted gross income may be deductible if you choose to itemize your deductions on your federal return. For seniors carrying substantial medical costs, which can include health insurance premiums, prescription medications, dental procedures, vision care, hearing aids, medical devices and equipment, and long-term care-related expenses, this deduction can represent an enormous financial benefit. Many retirees do not realise that even the Medicare Part B and Part D premiums that are automatically deducted from their Social Security payments count toward this threshold. The same goes for supplemental insurance premiums, certain home modifications made for documented medical purposes, transportation costs associated with travelling to and from medical appointments, and numerous other expenses that most seniors never bother to track throughout the year. The most frequently made error is assuming the standard deduction is always the superior choice, even when total medical spending has been significant. For certain seniors carrying considerable medical bills, choosing to itemize and claim the medical expense deduction can result in substantially lower federal taxes overall. Before your next return is prepared and filed, discuss with a qualified tax professional whether itemizing your deductions would produce a better outcome for your specific financial situation. And maintain careful, organized records of every medical expense you incur throughout the year. The seniors who track their spending diligently are the ones who save thousands. Those who do not simply default to the standard deduction and forfeit the potential benefit. Tax Bill number 7, Property Transfer Tax and Gift Tax on transfers made within the family. This is one of the most consistently overlooked tax categories in all of retirement planning, and one of the most financially damaging when seniors make errors in handling it. When seniors transfer property to their adult children, grandchildren, or other family members, certain taxes can come into play depending entirely on how the transfer is structured and documented. Property transfer taxes, gift taxes, capital gains complications, and state-specific regulations all interact in ways that most families never anticipate or prepare for in advance. The encouraging news is that many states provide specific exemptions for parent-to-child and grandparent-to-grandchild property transfers. Certain states allow families to transfer home ownership without triggering a full property tax reassessment, which can spare the next generation tens of thousands of dollars in ongoing annual property taxes. The federal gift tax exclusion currently permits individuals to transfer a specified dollar amount per year per recipient without generating any federal gift tax consequences. For married couples making joint gifts, that exclusion amount can be doubled. The most damaging mistake made in this area is completing a property transfer to a family member without first understanding the full scope of the tax implications involved. A well-meaning and generous gift can sometimes trigger thousands of dollars in unexpected tax liabilities, cause the recipient to lose valuable property tax exemptions, or create future capital gains complications for the person receiving the transfer. Before conveying any significant property, real estate holdings, or substantial financial gift to a family member, take the time to consult with a qualified tax professional or estate attorney. The cost of that professional conversation represents a tiny fraction of what you could save by avoiding even a single costly misstep. Now let me bring everything together with a calm and practical checklist you can begin using today, regardless of which state you call home. 1. Contact your county tax assessor's office and ask specifically about senior property tax exemptions, freeze programs, circuit breaker provisions, veterans and senior combined exemptions, and deferral programs that may be available in your county. 2. Confirm with your tax professional that you have been claiming the additional federal standard deduction designated for seniors on every return you have filed since reaching age 65. If that has not been happening consistently, ask whether prior year returns are eligible to be amended and corrected. 3. Determine whether your state applies income tax to Social Security benefits, and if it does, find out whether you qualify for any senior-specific exemptions or reductions. Consider arranging a conversation with a qualified tax professional who is familiar with your state's specific rules. 4. If you are thinking about selling your primary residence, speak with a qualified tax professional or real estate attorney about how the federal capital gains exclusion applies to your particular situation before you take any steps toward listing the property. 5. Before your next scheduled DMV visit, call your state's Department of Motor Vehicles and ask directly about senior discounts that may apply to vehicle registration, license renewal, and identification card fees. 6. Maintain detailed and organised records of every medical expense you pay throughout the year, including Medicare premiums, supplemental insurance costs, prescription expenses, dental care, vision care, hearing-related costs, and any transportation connected to medical appointments. At tax filing time, ask your tax professional whether itemising your deductions and claiming the medical expense deduction would produce a greater benefit than simply taking the standard deduction. 7. Before transferring any significant property or making any substantial financial gift to a family member, schedule a consultation with a qualified tax professional or estate attorney to fully understand both the federal and state tax consequences involved. A single hour invested in advanced planning can protect your family from losing tens of thousands of dollars. These are not tricks. These are not loopholes exploiting gaps in the system. They are genuine federal and state tax provisions written specifically to help American seniors retain more of the money they worked their entire lives to earn. The retirees who understand these rules are the ones who benefit from them. The ones who remain unaware simply continue paying. And now an important reminder before we close, this video is intended solely for educational purposes. It does not constitute financial, legal, tax, medical, Social Security, or Medicare advice of any kind. Retirement Watch is not affiliated with the IRS, any state Department of Revenue, any county government entity, the Social Security Administration, Medicare, or any other government agency. Eligibility for any program, exemption or deduction depends entirely on your individual circumstances, your state of residence, your county, your income level, and various other personal factors. tax laws, exemption thresholds, and qualification requirements are subject to change. Always verify your specific eligibility directly with your local county tax assessor's office, your state's Department of Revenue, the IRS at irs.gov, or a qualified tax professional, a state attorney, or financial advisor who is thoroughly familiar with the regulations in your specific location before making any financial decisions. If you have stayed with me to this point in the video, I genuinely thank you for that. The fact that you committed to watching this entire conversation already places you ahead of the majority of American seniors. You are doing exactly what the retirees who protect and preserve more of their money consistently do. You are slowing down, paying careful attention, and learning the rules before someone else ends up benefiting from your lack of awareness. That single habit, more than any individual financial strategy or shortcut, is what distinguishes a comfortable and secure retirement from one filled with financial stress. If this video delivered value to you today, please subscribe to Retirement Watch and enable the bell notification. We publish fresh videos every week that explain Social Security, Medicare, taxes, and retirement regulations in clear and straightforward English, with the same calm and pressure-free approach you experience throughout this video. The seniors who follow this channel consistently are the ones who save thousands of dollars each year, the ones who do not simply keep on paying, and please take a moment to share this video with someone in your life who could genuinely benefit from it. A parent, a sibling, a spouse, a neighbour, a friend from church, or your community. Sometimes the most caring thing you can do for the people who matter most to you is to pass along a video they did not know they were missing. A brief conversation today, sparked by you sharing this content, could save someone you love thousands of dollars every single year for the rest of their life. Before you leave, I would love to hear your thoughts. Drop a comment below and tell me which of these 7 tax bills surprised you the most. Was it property taxes, the additional federal standard deduction for seniors, state income tax applied to Social Security benefits, capital gains on the sale of your home, vehicle and DMV-related fees, medical expense deductions, or property transfer and gift taxes on family transfers? I do read those comments. They directly inform which topics I choose to explore in greater depth in future videos. Take good care of yourself. Take good care of the people you love, and I will see you in the next one.